Welcome to Iron Financial. I am your lead analyst. And look, our mission here is absolutely simple. We are here to help you forge a stronger portfolio, cut right through the market weakness, and find the structural integrity in the numbers. Because, let's face it, in a market where consumer discretionary stocks are just getting hammered by cautious spending and inflation fears, finding a truly resilient asset is incredibly rare. So today, we are tearing down the Q1 2026 earnings report from YETI Holdings. The big question we're answering today, are we looking at a stock built of solid iron, or is this just retail foam? Joining me to really pressure test this structure is our market skeptic. Great to be here. And look, I'm representing everyone out there on the trading floor who sees a premium cooler company suddenly catching massive bids in what is arguably a really tough economy. My job today is to ask the hard question, is this all just hype, or is it real strength? Because we need absolute clarity before anyone risks their hard-earned capital.
Well, let's get you that clarity. Here is today's blueprint. We're going to start with the hook, asking if this is hype or real strength. Then we'll drill down into the heavy lifting, followed by a drill down into the cracks in their armor. After that, we'll look at the blueprint for future guidance and their buyback defense. And finally, we will deliver our verdict. Is this an opportunity or a trap? Let's get to work.
First up, Section 1, the hook. Hype or real strength? Market skeptic. Okay, let's just start right here. You look at the screens and suddenly everyone is talking about premium drinkware and heavy-duty coolers. Why does this matter right now? Like you just said, consumer discretionary stocks are supposed to be struggling. Middle-class spending is tightening across the board, and yet YETI is somehow defying gravity. I need to know why this specific print caught so much attention. It matters because of the pure velocity of the reaction to this print. We aren't just looking at a minor, run-of-the-mill beat here. We're looking at a market aggressively repricing an asset in real time, all based on a fundamental shift in its forward guidance and top-line resilience.
Lead analyst. We saw a massive 9.6% pre-market stock jump immediately following the Q1 release. YETI reported adjusted earnings per share of 26 cents. That completely blew past the Wall Street estimates of 18 cents. Revenue came in at $380.4 million, pushing right ahead of the $374.9 million consensus. Now, Wall Street was projecting that low 18-cent EPS because analysts essentially assumed that the tapped-out middle-class consumer would finally stop buying $300 coolers and $40 mugs. So this nearly 10% jump? That is the market violently correcting its bearish thesis, after YETI literally proved them wrong. Okay, a 9.6% jump is aggressive, there is no doubt about that. But a stock popping on a single earnings beat is often just a headline, right? What I want to know is if this jump is a temporary sugar high driven by short-term retail momentum, or if it represents a genuinely solid foundation. Is this something long-term investors can actually build a lasting position on?
That is exactly the question we have to answer today. Is the market buying a stock forged of iron, or a paper tiger masking underlying structural weakness? To answer that, we can't just look at the stock price. That's surface level. We have to rip up the floorboards and examine the actual segment data flowing through this business.
Moving to Section 2, drill down, the heavy lifting. We are going to start with the top-line revenue foundation, the real heavy lifting of the quarter, to expose exactly what is driving this 8% year-over-year sales growth. We need to know if the core pillars of their product lines are actually holding up under the weight of these macroeconomic pressures. Market skeptic, show me the steal. If they are successfully selling premium products in a tough economy, I want to see exactly which products are moving and exactly where they are being sold.
Let's look at the load-bearing numbers. Total net sales hit $380.4 million, which is up 8%. But look closer at the internal mechanics here. Coolers and equipment is doing the real heavy lifting, surging 11% to $156.1 million. That is massive double-digit growth in their absolute highest ticket items. Drinkware also showed a sturdy 5% growth to $216.9 million. What's actually driving this is an incredibly robust global innovation cycle. They've been expanding their day trip soft cooler bags, and they recently launched Scala, which is their first family of hike packs. This is a brilliant strategic move, honestly. The Scala line captures a totally new demographic of outdoor enthusiasts who might not ever buy a giant hard-sided fishing cooler, but they absolutely want premium, durable hiking gear. Meanwhile, the day trip soft bags allow deeper penetration into the everyday urban commuter market. They are proving they aren't just some one-trick pony relying on legacy products. They are aggressively expanding their core outdoor categories.
Market skeptic. I'll admit, 11% growth in really expensive coolers and successfully expanding into new hike packs is impressive. But where is the geographical demand actually coming from? Is this just a domestic U.S. story?
Actually, no. The demand is very broad-based. U.S. sales grew 8% and international sales grew 9%. So geographically, the structure is totally sound. But, as we are about to see, the channel mix tells a far more complicated story.
Hang on, hold the phone. You've got wholesale up 19% to $183.6 million, but direct-to-consumer, their DTC channel, is completely flat at $196.8 million. If consumer demand is supposedly so incredibly strong for these new hike packs and mugs, why is their direct web and retail traffic completely stalled out? That is the exact right question to ask. You are absolutely right to point out the flat DTC growth, which at first glance looks like a massive crack in the foundation. However, management clarified that everyday consumer demand across YETI websites, Amazon, and physical retail stores was actually strong and tracked perfectly in line with their overall top-line growth. The flatness in the DTC segment was almost entirely due to a significant decline in global corporate sales. Corporate sales? You mean like businesses buying in bulk? Exactly. Corporations are actively slashing their B2B marketing and promotional budgets right now. You have major tech sector layoffs, financial firms pulling back on discretionary corporate gifting. Those customized laser-engraved YETI mugs that companies hand out at corporate retreats or as premium client gifts, those are often the very first things cut from a tightened corporate budget. That B2B pullback acted as a massive anchor on the entire DTC segment. So right now, that 19% surge in wholesale, which by the way is their best quarterly performance in over 3 years, that is the main steel beam supporting the entire revenue structure.
All right, Section 3, drill down, cracks in armor. You've shown me the revenue beams, and okay, they look mostly solid. But revenue is vanity, profit is sanity. I want to shift focus to the bottom line right now. Let's inspect the actual profits bleeding out of this company, because I have a feeling the foundation isn't as clean as the top line suggests.
You're not wrong to look for stress fractures. Top-line growth means absolutely nothing if the structural costs are rotting from the inside. Let's pull back the curtain and look at the margins.
See, this right here is exactly what I'm talking about. Look at this harsh contrast. We just praised an 8% revenue increase, but diluted EPS plunged a terrifying 35% down to 13 cents. Even if you look at their adjusted EPS, it decreased 16% to 26 cents. Net income dropped 41% down to just $9.9 million. How can you possibly defend the structural integrity of a business that is selling a higher volume of products but making substantially less money on every single unit out the door? It is a vital stress point for sure. A 35% drop in unadjusted EPS is a massive structural failure if left unaddressed. The company is generating more revenue, yes, but the structural cost to generate that revenue has spiked severely. We need to measure the exact depth of these cracks to see if the building is at risk of total collapse.
Lead analyst. The severity of the margin compression here is totally undeniable. Gross margins dropped a brutal 210 basis points, down to 55.3%. Operating margins dropped to a razor-thin 3.3%. The armor is buckling. Why? Well, there are two main reasons. First, less favorable channel and category mix shifts. Remember that massive 19% wholesale growth we just discussed? Wholesale inherently requires surrendering a significant cut of the profit to retail partners like Dick's Sporting Goods or REI. You are also frequently offering bulk discounts to those distributors just to secure prime floor space. Direct-to-consumer, on the other hand, captures the full premium margin. So when your high-margin DTC channel stalls out due to those corporate pullbacks and your lower-margin wholesale channel surges 19%, your overall profitability mix gets severely diluted. Market skeptic. Okay, mix shift I understand. That's a structural reality of retail operations. But 210 basis points is a huge drop. Mix shift alone doesn't cause that kind of structural damage to a premium brand. What's the rest of the story here?
The rest of the story is incremental tariffs. This is the rust rapidly eating away at the company's steel foundation. YETI has significant supply chain exposure because they historically manufacture a large portion of their products in China and the broader Southeast Asia region. Recently, they were hit with incremental Section 301 tariffs on specific goods imported into the U.S., most notably heavily impacting their soft coolers and certain drinkware categories. In Q1 alone, these new tariffs drove a 280 basis point hit to gross margins, translating to an estimated 9-cent per share headwind. To put that in perspective, if you remove that 9-cent tax penalty, their adjusted EPS would have been completely flat year over year instead of down.
Market skeptic. And this isn't just some temporary one-quarter supply chain glitch, is it?
No, absolutely not. This is a direct consequence of geopolitical trade policies acting as a persistent structural tax on their cost of goods sold. Management explicitly stated that tariffs will add roughly $80 million to their cost of goods relative to 2024. That represents approximately 430 basis points of negative impact on their gross margins for the full year 2026. That is a heavy, persistent weight placed directly on the structure.
So that brings us to Section 4, the blueprint, future guidance. The absolutely crucial point here is figuring out if management has an operational blueprint to patch these massive cracks or if the structure is just going to fail. Let's pivot to their forward guidance for the rest of fiscal 2026. Remember, the market looks forward, not backward.
Look, after absorbing an $80 million tariff hit, they better have a flawless blueprint, or this stock is going to collapse under its own operational weight. Let's see these projections.
Well, management is projecting pure, unadulterated confidence. They actually raised their 2026 guidance. They bumped the lower end of sales growth to a new, tighter range of 7% to 8%. They increased adjusted operating margin expectations to approximately 14.6%. Most importantly, they raised adjusted EPS to a range of $2.83 to $2.89, which reflects a massive 14 to 17% bottom-line growth for the year. And they expect to generate between $200 and $225 million in free cash flow. Wait a second. They're eating an $80 million tariff hit, yet they are raising operating margin and EPS guidance for the full year? How does that math possibly work? They're pulling several levers at once. First, they are actively shifting their production footprint outside of high tariff zones. Specifically, they're expanding manufacturing in places like Vietnam and the Philippines over the next 24 months. Second, they are utilizing new automated production lines in the first half of this year to drive down the per-unit cost of manufacturing and resolve supply constraints on popular items. Finally, they are taking strategic surgical price increases on specific high-demand product lines to defend their margins. They firmly believe this combination of operational leverage, aggressive global market expansion, and sustained top-line momentum will ultimately outpace the tariff rust.
Okay, Section 5. The blueprint. Buyback defense. I don't know, man. Upgrading guidance in the face of severe margin compression and massive geopolitical tax burdens makes me incredibly nervous. It honestly makes me wonder if they are using their balance sheet to artificially prop up the stock price to mask organic weakness. Are we looking at a genuine growth story here or just clever financial engineering?
You're referring to their capital allocation strategy, specifically their aggressive share repurchases. Let's open up that part of the blueprint and examine what we're calling their buyback defense.
We are looking at a multi-year history of massive capital allocation. In 2024, they executed $200 million in accelerated share repurchase agreements. For those unfamiliar, ASRs mean they enter a contract with an investment bank to retire a massive block of shares immediately, locking in the capital deployment upfront. It's an aggressive move. Then in 2025, they did $300 million in open market repurchases, which is more opportunistic, letting management just buy the dip when the stock trades below what they see as its intrinsic value. Both methods drastically reduce the float. Over just those 2 years, they repurchased over 13 million shares, which is a staggering 14% reduction in their total shares outstanding. And now, in May 2026, the board just approved an expansion of the program, increasing the total authorization to $500 million. A 14% reduction in float over 2 years is absolutely massive. When you reduce the total share count by that much, of course your earnings per share looks better on paper. It mathematically forces EPS up even if the actual core net income of the business is sluggish. This is exactly what I meant earlier by structural padding. You can call it structural padding if you want, but you can also call it a fortress balance sheet. Because to execute buybacks of that magnitude, you need cold, hard cash, and YETI has it. They ended Q1 with $127.8 million in cash and an undrawn $300 million revolver. Meanwhile, their total debt is incredibly low at just $72.8 million. Furthermore, their inventory actually decreased 4%, down to $318.4 million. In a retail environment dealing with wildly shifting consumer demand, seeing a 4% decrease in inventory while simultaneously growing top-line sales by 8% is a massive indicator of structural health. It means product is flying off the shelves, they aren't over-ordering, and most importantly, it avoids the need for heavy margin-destroying clearance discounts later in the year. I'll concede that having nearly $130 million in cash, low debt, and clean inventory is a very strong defensive moat. They certainly have the liquidity to survive the $80 million tariff hit without taking on toxic debt. But surviving isn't the same as thriving. A massive buyback floor protects the downside for sure, but it doesn't guarantee genuine organic growth on the upside.
That takes us to Section 6. The verdict: opportunity or trap? This brings us to the ultimate question for this explainer. We've torn down the top line, we've exposed the margin cracks, evaluated the operational guidance, and stress-tested the balance sheet. It is time to bring these arguments together to deliver a final, no-nonsense ruling for our Iron Financial audience.
Let's lay it all out on the table right now. The market pushed this up 9.6% out of the gate. Does the structure actually hold that weight, or does it collapse?
I'll summarize the bear case first.
The trap is simple and it is dangerous. You have flat direct-to-consumer sales, dragged down by weak corporate spending. You have severely crushed margins, a 210 basis point drop, and you have an inescapable $80 million in geopolitical tariff headwinds serving as a persistent tax for the entire year. This company is currently selling more products to make less actual profit. If that wholesale channel blinks even a little bit, this stock falls straight through the floorboards. And I will counter with the bull case. The opportunity is forged in resilience. The top-line structure is undeniable. 11% growth in high-ticket coolers, and a 19% surge in wholesale proving exceptional brand momentum. Management is actively shifting their supply chain and holds such high confidence in their innovation pipeline that they literally raised full-year guidance across sales, operating margins, and EPS despite the macro environment. Add in a fortress balance sheet with low debt, clean inventory, and a relentless $500 million share buyback program that acts as a concrete floor under the stock price. The foundation, despite the tariff rust, is reinforced with iron.
We've laid out the structural blueprints for you. The top-line growth and aggressive capital allocation are incredibly strong, but the margin compression stemming from those heavy tariffs requires vigilant monitoring. Now, the final decision rests purely on your own investment framework and risk tolerance. YETI is executing its strategy in a very hostile macro environment, but market volatility tests every single foundation. The final question we leave you with today: is your portfolio forged strongly enough to withstand the pressure and hold YETI through the noise? Thank you for joining us on this explainer. Keep your foundation strong, and we will see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.